So with that brief introduction, I want to introduce Senior Tax Manager Rick Dynoske and also another tax manager, Michael Weber, who are going to speak to the first agenda item, which is, international tax updates. So guys, it's on to you. Thank you all for coming. Have a great day.
Welcome, everyone, and thanks for coming today. As Bob mentioned, my name is Mike Weber, and I'm a tax manager in our tax services group, and this is Rick Dynoske. He's the senior manager in the tax services group. Today's first topic is going to be about the current developments in United States international taxation. This has been a big topic in the news over the last several years as a lot of entities move some of their operations overseas. We wanted to give everybody an update on how that exactly works, as well as some individual items. When Rick and I went through this topic, we broke it down into 4 different items. The first being a general overview on the U.S. taxation system with a special emphasis on entity taxation.
I'll be talking about the individual requirements for a resident alien versus a non-resident alien. And I also want to touch on the reporting requirements for having an offshore account that the IRS is pretty hot about.
And then we're going to move on to some basic treaty provisions and concepts, and at the end we have a slide that's going to walk through each of what we think are the most applicable U.S. international IRS forms, and if time permits, we're going to go through each one of those forms and explain what they're used for. But before we get started on today's presentation, Rick and I were getting a lot of questions out in the lobby about how did we get to become the first speakers here today. Well, I'll have you know that we had a firm meeting last month, and Bob said that he was throwing out all these code sections, and he said the first person to correctly identify a specific code section could be the first speaker, so he started throwing code sections out. So when he got to 168, little e, 3, big A, little I, Rick and I were the first ones to buzz in that said, aha, that's the code section for the depreciable life of a racehorse.
Which is 3 years.
Which is 3 years. So here we are as the first speakers here today.
Yeah. It took us weeks to come up with that joke. So.
There's really 2 types of tax systems in the world today. One being the territorial tax regime, where a specific country or jurisdiction looks to basically tax the income that is earned within their borders. And you compare that against what the United States has, and that is a worldwide tax regime where we tax our citizens, our residents, and our corporations on their worldwide income, no matter where it is earned. As everybody probably knows, on the individual side, we have a progressive tax system where, depending on how much income you earn, there's a marginal rate. As you fill up the lower buckets, the more income you have, it's taxed at a higher marginal rate. The corporate code sort of works the same way. We have a graduated scale, but effectively you're looking at basically a 35% tax on the C corporations. When we're talking about U.S. international taxation, there's basically 2 types of transactions. There are inbound transactions and there are outbound transactions. The inbound transactions are basically foreign persons who are investing in the United States. You compare that with the outbound transactions, which are citizens, residents, and corporations who are engaging in some type of operation outside of the United States. And that's really what I want to focus on today, is those outbound transactions and what are, as Rick's going to talk about, individuals and residents, what are they doing overseas and what are entities doing overseas. But I want to take a second to just talk about where does the United States compare with the rest of the world. There's an organization for economic cooperation and development, which is the OECD. It's made up of 35 industrialized nations that gets together throughout the course of every year, and they talk about different policy developments and economical issues and all kinds of different things. And of those 34 industrialized nations, the United States has the highest corporate tax rate. The Tax Foundation also sent out a survey to every single nation. 163 of them returned, and the U.S. was the 3rd highest one. As a side note, the only two that were higher than the United States were the United Arab Emirates, which has a 55% corporate tax, mainly on oil, and the country of Chad in Africa, which has a 50% tax. So when you think about that, what's actually happening in our economic environment here in the United States? Well, since the corporate tax rate is so high, a lot of entities are moving their operations overseas because they'd like to earn their income in some other jurisdiction and try to remove themselves from the U.S. corporate tax code and only subject themselves to tax in some other jurisdiction where, as you can see, there's only really two higher than us, so as long as you're doing operations somewhere else, you're effectively paying a lower tax. That also, since our corporate tax code is so high, it really serves to shut down foreign investment here into the United States, because if I have operations over in a country that has a 10% rate, why would I want to come here and pay a 34% rate or 35% rate when where I'm currently doing operations, I'm only paying a 10% rate? Before we dive into the big details about how this all functions, I want to sort of take a step back and talk about how we even got to this. Back in 1913, the 16th Amendment to the U.S. Constitution was put into place, which gave Congress the power to tax individuals, residents, and corporations. And shortly thereafter, in 1924, there was this case, Cook versus Tate, which challenged the idea of a territorial tax regime here in the United States versus a worldwide tax regime. This gentleman, Mr. Cook, was a U.S. citizen who resided in Mexico. He had property in Mexico. He was earning income from that property in Mexico. And the United States wanted to tax him on his worldwide income. And he came in and said, well, no, look, the way it works, the way it's supposed to work here is we're supposed to have a territorial regime. I'm only supposed to get taxed on the income that I earn within the United States. And since this piece of property is in Mexico and I'm residing in Mexico, the U.S. has no right to tax that. And the Supreme Court basically said, while that's a great argument, we don't really agree with you. You don't look to where the income is earned or where you're residing. You look to the relationship between the citizen, between the resident, between the corporation, and the United States. And so if you are a citizen, if you are a resident of the United States, or if you are a corporation who is formed here in the United States, then there are certain benefits that are derived from that relationship between you and the United States and vice versa. So each side's sort of benefiting from that. And so with that analysis, they said, again, it doesn't matter where you earn the income, it's about the relationship, and the relationship is we're going to tax you on your worldwide income. As sort of a side note, there's sort of a phenomenon here, though, because there's two types of rules in determining whether you're a citizen of the United States. And one, you can look to all the immigration rules, and they have their own specific set of rules, and the tax code has their own set of rules to determine whether you're a citizen. So it's possible that you may not be a citizen under the immigration rules, but you would be a citizen for U.S. tax rules. And so if you were still a citizen for U.S. tax rules, the IRS is going to tax you on your worldwide income. But if the analysis is supposed to be about the relationship between you and the United States, and you're not a citizen under immigration rules, you're sort of in a quagmire there. So if anybody wants to further advance their career and take that to the Supreme Court, go right ahead. As I mentioned before, there's two types of transactions in the international arena. There are inbound transactions, which involve foreign persons investing in the United States. There's two types of transactions when we're talking about inbound transactions. One, it's income connected to a U.S. trade or business. If you have that, you're taxed on your profits at the regular graduated scale. You get all the deductions that go along with that. But if you have U.S. sourced income that's not effectively connected with the U.S. trade or business, then that's considered to be passive income. We're going to tax you at 30%. There's no deductions. And talking specifically about individuals here, if you look at the 1040 NR form that you're supposed to file there, you calculate your tax, and then there's a line item underneath there that says, well, what's your tax on this type of income, and you just plop it right in there, so you don't get any of the benefit of any of the deductions for that. Outbound transactions, again, this is where I'm going to focus on for the rest of my part of the presentation, and that is aiming to tax the worldwide income of U.S. persons, and specifically entities. And if you're a corp that's considered to be a U.S. person, you are going to be taxed on your worldwide income. And I really want everybody to kind of think about this specific example that I'm going to use throughout the rest of my presentation, and that is that you are a United States corporation that decides you want to do your operations overseas, and so you form another entity. I'm going to pick Switzerland. You form a Swiss entity that you own 100% of, and you're going to run all your foreign operations through that Swiss entity. Now, we get this question a lot. When I set up a situation like that, how do I know if I'm supposed to pay tax on whatever that Swiss entity is doing? Well, the first thing you have to determine is, how does the United States look at that Swiss entity? For U.S. tax purposes, do we look at that Swiss entity as a corporation or as a flow-through entity? There are specific kinds of corporations enlisted in the regulations to the Internal Revenue Code that say, if you set up your entity as one of these kinds of entities in these specific countries, the U.S. is always going to look at that entity as a corporation. And I'll explain why that's important in a minute. There are other ways to set up entities in different countries that aren't corporations. Like we have LLCs, we have LPs here, we have GPs here. Well, different countries have different methods by which you can set up different kinds of entities. And so these are, in the international arena, referred to as foreign eligible entities. Now, you have the ability to set up your entity in another country as under that country's laws as a limited liability company or some type of flow-through or pass-through. But for U.S. tax purposes, you could actually make a special election to say, well, even though it's a flow-through entity for Switzerland purposes, we want it to be a corp for U.S. purposes. So you file this form 8832, and that's an entity classification form. So if you set up your entity, again, over in Switzerland, that's a flow-through, you can, what's commonly referred to as reverse check the box and say, we want the U.S. to look at this entity as a corporation. The only problem with that form is, once you file that form, you can't change your entity classification for 5 years, but there is a special relief with this form that actually looks backwards 75 days, so you have a little bit of time to make a determination on how you want that entity to be treated for U.S. purposes. Now, here's why this matters. If it's a flow-through entity, as the income is earned or lost in these foreign entities overseas, again, Switzerland, then that U.S. company is going to report the income or loss as they incur it. So in year one, whatever happens over there, it just gets reported right on the U.S. return. For a corporation, though, the income doesn't get taxed until the money that's earned over there is repatriated. I'm sure everybody's heard that term in the news, repatriated back to the United States. That means we've earned income over in a foreign jurisdiction. We want to take that money and bring it back to the United States, the actual financial transfer over. That is when the U.S. company is going to be subject to tax there. The losses are not deductible, but there's a special classification in the code here that if the foreign company that you have set up is considered to be a controlled foreign corporation, then you're going to have to report the income, if it's what's commonly referred to as subpart F income, immediately. So if you have this special kind of subpart F income, which we're going to go into a couple of the details as we move forward here, then you're going to have to report that subpart F income on your U.S. tax return, even before you bring the money back. That subpart F income is taxed at ordinary income tax rate, so you're 35% immediately, even before you bring the money back. And it's basically comprised of foreign-based company income, and we're going to talk about all the details associated with that. So how do you determine whether you're a controlled foreign corp? Well, you have to be owned by more than 50% of U.S. persons. Well, what's a U.S. person? Well, that's at least a 10% owner of a foreign corporation. So basically, you got to do all the math there and figure out, hey, have I set up a controlled foreign corporation? And if you've done that, you have to report your pro rata share of that subpart F income immediately as it's earned over in a foreign jurisdiction. Now, there's also another item here. It has to be a controlled foreign corporation for an uninterrupted period of at least 30 days during that specific calendar year. Foreign-based company income, as I've listed out here, there's basically, I've got 5 different kinds up here. There's more. We don't have time to go into all of the details. I wanted to basically break out all the basic ones and the ones that you might see in the news or you might encounter in your day-to-day operations if you decide to go this route. The first one is basically foreign personal holding income, and this is dividends, interest, rents, royalties, annuities. So if that foreign corp is a controlled foreign corp and they're getting interest income or dividend income or rental income or royalty income, that's going to be subpart F income, which is included on the U.S. return even before you bring the money back. Now there's all kinds of special exceptions and exclusions, and if you dive in real deep into the code, there's a lot of ways to get around all of this stuff. One of them is, I'll just point out here under the foreign personal holding company income rules, is if you're receiving royalty income, there's a way to exclude it if your foreign corporation is actively engaged in a trade or business. So you can't just transfer your intellectual property off seas and then use that intellectual property to, conduct business over there, but you're not actively engaged in a trade or business. That's going to be included. But if there's actual operations over there, you're developing the intellectual property, then again, it meets this specific exclusion. I think the one that is, in the news the most that people don't fully understand is the foreign-based company sales income. That's if you have a foreign corporation that is buying manufactured products from another unrelated party, and they're just buying it and then selling it all over the world. The U.S. is going to say, no, that's subpart F income too. We're going to make you include that as income on your U.S. tax return as you earn that income. The way to kind of get around this is if you actually manufacture the product in the controlled foreign corp's country of organization, then that's one of the exceptions to this rule. So what I think everybody's sort of seeing is, well, we'll set up this foreign corp in, say, a country that has like sort of low labor costs and a low income tax rate, so we could manufacture that product there and then sell it all over the world. And that's how we jam the profits into that foreign corp, and we're not going to be able to tax it here in the United States until we bring that money back. I think one item that I just want to mention about this whole idea of subpart F inclusions and when do you report it as income and how that's all working, well, you really have to track all these items in what's called a previously taxed income account. You look at this account and say, okay, well, what are my subpart F inclusions that I've already recorded over here in the United States? So when I bring that money back, I just serve to reduce that account so that I don't get double taxed on that. The only problem with that is you really have to pay attention to how that's working, because when you have that subpart F inclusion, let's say you're operating in the euro, it might be 1-to-1 with the dollar, but when you actually bring the money back, it might be 2-to-1 or 50 cents to 1. So you could potentially have a foreign currency gain or loss there. So you really have to keep track of what's going on over there. That sort of brings me to the repatriation in today's environment. Like I said, I think this is a really big topic in today's world. What are we going to do about all these profits that are earned overseas that the U.S. really can't touch? They can't tax it until it's brought back here. Well, there's been proposals out there, I think, for years that, okay, we'll give these corporations some time, some measure of time, a month, 6 months, and allow you to bring those profits back, and we're not going to tax you at 35%. Maybe we'll tax it at 5% or 10% or 15%. Insert whatever number you want to insert in there. The only problem with that is, well, why are we letting those companies bring it back? What's the point of it? Okay, so yeah, we get the tax revenue, but are we hoping that they take that money and invest it in the economy, that they give new jobs or increase the workforce, they build new property, they sort of invest in our economy? Well, we've tried this in the past, and it seems like, okay, we bring the money back, and then the corporation just issues a dividend to the shareholder. So if that's really the avenue by which you want to go down, you really have to think about how are we going to force corporations to do that which we want them to do. And everything I've talked about today, all the foreign profits that are earned overseas, according to Bloomberg right now, of U.S. corporations, $2.1 trillion that have earned in foreign jurisdictions that the United States has never taxed. Now, I've listed the 5 biggest ones here, again, according to Bloomberg: General Electric, Microsoft, Pfizer, Apple, IBM. You can see the billions of dollars that they have over there that again, the U.S. has not taxed. That brings me just to my final point here that I think is really relevant in this arena, and that's the idea of corporate inversions. Basically, right now, if you use my example of the U.S. company that sets up a Swiss company, again, the U.S. isn't going to tax that money until it's repatriated back to the United States, or they have those subpart F inclusions. Well, corporate inversion basically flips everything on its head and says, well, the Swiss entity now owns the U.S. entity, so whatever the Swiss entity is doing all over the world, The United States is never going to get a piece of that. They're only going to get a piece of the operations happening here in the U.S. So there's all kinds of crazy rules about how you can do that, but basically it's taking a U.S. parent that owns a foreign company and turning itself on its head and saying the foreign parent now owns the U.S. company. And with that, I'm going to turn it over to Rick.
Thanks, Mike. Like I said, I'm going to talk about the individual filing requirements for both resident aliens and non-resident aliens. As you're all aware of, if you're a U.S. citizen, you file your Form 1040 on your worldwide income, which is due April 15th for the preceding year. Now, if you're a U.S. citizen working abroad in another country, you do get an automatic 2-month extension to file your Form 1040, but any tax is due on April 15th, so you want to make sure you get your tax paid in so you don't get hit with any interest or penalties at that point in time. How to determine you're a U.S. resident or not? Sometimes it's determined in the tax treaties, and as Mike will talk about, there's over 90 different treaties. If no treaty exists, you can become a U.S. resident if you're a lawful permanent resident at any point in time during the calendar year, or you meet what's called a substantial presence test. That's a 183-day test. I'll talk about that in a minute. Also, there's different elections you can make to be treated as a resident alien versus a non-resident alien. I'll talk about the differences there because typically you want to be a resident alien because you get the full U.S. income tax rules, deductions, credits, as opposed to a non-resident alien like Mike spoke of. You don't get as many of those perks. So what's a lawful permanent resident? That's basically the green card test. You have to apply to the U.S. Immigration Service, so you have to run through lots of hoops to get that. The substantial presence test, like I mentioned, you have to be present in the U.S. at least 183 days over a 3-year period. However, they don't make it that easy. You have to be at least in the country for 31 days in the current year. And you go back to the second preceding year, it's weighted. Every day in that year is worth 1/6 of a day. If you go back to the prior year, every day is worth 1/3 of a day. And if you add all those up and you hit the 183 mark, you're a resident alien. You get all the perks filing as a 1040. A lot of individuals are excluded from this calculation, such as employees from foreign governments. Certain days don't count in the calculation, so you have to be careful for travel back and forth between your home country and the U.S. Also, if it's for medical or commuting time, they disallow those days. There's also the ability to make a part-year election. As long as you're in the U.S. for at least 31 days, you can make what's called a first-year choice election. And we've had clients that come in, an alien will come in November. They'll be here from November through December. And we know they're going to be here for a full year in 2016. So when April 15th comes up, we'll extend their return and make sure we pay all their tax in. And then once they hit that 183-day test, we can then file their, as a 1040, a resident alien. There's some elections you have to put on there, but it's a much better tax outcome than filing as a non-resident. Again, I spoke of non-resident aliens. If you cannot meet any of these tests, you'll have to file a non-resident alien return, which I said is quite different from the 1040. You are subject to any U.S. sourced income, as Mike spoke of, and that's income that's effectively connected with the U.S. trade or business. The tax rate is the same as a U.S. citizen. So if I'm a German citizen and I have a operation here in the United States as a partnership, I'm a partner, that's effectively connected income. I have to pay tax on that to the U.S. And there are mechanisms in place at the partnership level where the IRS is going to require that partnership to withhold a tax on my earnings. And there are penalties, severe penalties, if they don't do that. Because if they don't withhold it, who's going to say I'm going to file a return and pay that tax? This way, when they withhold it, I file my return and I might get a refund or I may get a little bit more. But I think it's like 30% they usually make you withhold depending on the treaty. If it's investment income, it's a flat 30% they make you pay tax on if you're a non-resident alien. And again, that could differ based on the treaty that's in effect. Some treaties take it down to 15%, so you do need to look at your treaty and see what that tax rate is. And again, the U.S. payor is required to withhold that tax. As I said, it's reported on the 1040 NR. It's real similar to the Form 1040, except, like I said, there's a lot of deductions you don't get. You don't get the graduated tax rates in some instances. So it is always better to try to get that resident alien status as opposed to the non-resident. So let's flip it on the other side. Let's say you have an employee or you yourself are being shipped over to, say, China for a 3-year project. Any income that you earn over there as a U.S. citizen is taxed here in the U.S. as worldwide income. Also, China's probably going to want their cut of that income. So in order to prevent this double taxation, Congress put into play this foreign earned income exclusion. It's actually a form. It's Form 2555 that you use, and you have to meet run through a couple of hoops. One of them being that you have to have a tax home in a foreign country, and you have to meet the bona fide residence and physical presence test. That just means you have to be there for at least 330 days to meet these tests, and then you can apply for this exclusion. And what the exclusion is, it's adjusted every year for inflation. Right now, it's about $100,000. So if you go to China, you earn $100,000. The U.S. is going to let you exclude that $100,000 off your U.S. return. So it's a nice perk, so you're not getting the double taxation. Also, the calculation requires you determine the actual exclusion amount. So sometimes if you take that income out and you still have U.S. income, it could be taxed at a higher rate. So they do catch you there a little bit, but you're still getting that exclusion. That's a great perk. The second area I want to talk about, as you're all aware of, the IRS has access to all your investment income. Your 1099s, come right to for U.S. purposes, come to them. Your Schedule K-1s. So they have a pretty good idea of your U.S. income. What they don't know is your worldwide income, and they've been struggling with this for years. So about 10 years ago, they got pretty aggravated and really went after this, and what's called the Report of Foreign Bank and Financial Accounts, or what you may be familiar with as FBARs. It's their effort to try to capture this worldwide income and make sure everyone's reporting it on their tax return, and they want to be aware of what foreign accounts everybody has. So what is the FBAR cover? Basically, if a taxpayer has a bank account, you hold securities or other types of financial accounts outside the United States, like I said, that income has to be reported on your U.S. income tax return, or your return is not correct. Taxpayers must also disclose if they had a financial interest in or a signature authority over an account located in a foreign country by filing what's called a FinCEN Form 114. That's basically the FBAR form. Now on your 1040, on your Schedule B, your interest and dividends, on the very bottom of that form, it's going to ask you these questions. Did you have a financial interest in or a signature authority over a foreign account? If you mark that yes, and then it'll ask you, do you need to file the FinCEN Form 114? If you mark that yes, but don't file the FBAR, that's going to be a red flag, and they're going to be looking for that FBAR. The FBAR is one of 5 reports required under the Bank Secrecy Act. There is a $10,000 minimum threshold on the aggregate value, and I'll explain that in a minute. The due date, the FinCEN 114 is a separate form. It's not part of your 1040, so you do need to file that separately, and it's not due on April 15th. It's due on June 30th, so it's a whole new, different regime. And it's based on the preceding year. There's no extensions. You have to have it in by June 30th. If you're a day late, they will penalize you. There is talk about moving that date up to April 15th to coincide with the 1040s, and that may happen in 2017 because a lot of taxpayers would rather just get it done at that point instead of waiting and forgetting about it in June. Now here's the kicker, the penalties. If it's a non-willful failure to file, they could really hit you for $10,000 per year for not filing this form if you were required. So if you have a $50,000 account in France, you haven't filed this form in 5 years, they could hit you $10,000 every year, so that account would be basically gone after these penalties. Now, the worst one is if it's a willful failure, they come in and say you knew about it and you didn't file it. It's the greater of $100,000 or 50% of the balance. So if you have $1 million in another country, you haven't filed in 2 years, you're going to lose $500,000 the first year in penalties, and then second year you're going to lose $250,000, so you're down to $250,000 after the second year. And then they can also hit you with criminal penalties. So it's pretty serious. They will publicize this. They want to get this out there to make sure everybody's aware of it, and they want to get their arms around what type of income they're missing. What do they consider a U.S. person? As we spoke of, as if you're a citizen of the United States, this would apply to you, and also a resident of the United States. So when I talked about resident aliens, they would also be subject to FBAR filings because you're considered a resident of the United States. So anytime we get a resident alien, we're going to ask them specifically, do you have these accounts in your home country? First we have to explain them to what a 1040 is, then we got to explain this to them. So it's always fun, but most of the times they are going to have to file this, and if you don't see this form with their 1040, you got to ask the question. And then also we send out organizers to all our clients, and we do ask specifically if you have a foreign account, you need to let us know. What type of accounts are reportable? It's your bank accounts, your securities, and some other accounts. Requirements do not apply to accounts of international financial institutions of which the U.S. government is a member. You have to analyze the location of the account to determine if it is in a foreign country. So the branch must be located outside the United States. So what do I mean by that? Say I travel to England a lot, and there's a PNC bank in England, so I open an account there to make it convenient. Even though that's a U.S. bank, it's in a foreign country, so that would be a reportable account. Now, vice versa, if I have an account here, or a foreign financial account here with a branch of a foreign bank that's located here in the U.S., that would be a non-reportable account because it's here in the continental U.S. Financial interest, basically what that means, that's one of the questions they ask you, is that you are the owner of record and you're the holder of legal title to that account. Or you can also have constructive ownership, you're acting on behalf of a U.S. person with respect to that account. Signature authority, that's basically you have control on the disposition of the money, the funds, the assets by direct communication. So those are two key definitions. Again, when I talked about the reporting threshold, that's $10,000. And what that means is at any point in time, if your foreign accounts in the aggregate exceed $10,000, you're subject to the FinCEN reporting. So if you go through the whole year under 10,000, the last day of the year you go over 10,100, you're stuck. You have to file that. And the IRS will go through your monthly, your daily statements to see if you were required to file this form. What does the FinCEN 114 look like? It's basically just a two-page report. Just asks for your name, your address, your social security number, and then it's going to ask you for the foreign account, the name of the bank, the account number, then how much you have in there in U.S. dollars. You have to convert everything to U.S. dollars. So if you have 5 accounts, it's not that difficult to complete this return. If you got hundreds of accounts, you're going to need help getting that put together. So if you have a June 30th date, you don't want to be looking at this on June 29th and trying to get this in on time. Since this program has been in effect, the IRS didn't get a lot of responses from the U.S. Citizenship. So they decided to open up some voluntary disclosure programs, to help to relieve some of the penalties. So since 2009, since they opened these programs up, more than 50,000 taxpayers have come forward, and the IRS has collected over $7 billion in tax, penalties, and interest. So that's a pretty good take-in. Now, these voluntary disclosure programs can end at any time, but since due to the success, I don't see it ending at any time soon. But if you do know someone that is delinquent, this is the way to go. As I said, there's several options to bring you into compliance. As long as you paid the tax on the foreign income, so that you had interest and dividends, you reported on your 1040, you paid the tax, but you forgot to file your FBAR. What you would do is file your late FBAR, and most cases they will waive that penalty. As long as you paid your tax, they'll waive that penalty. If you didn't pay the tax, then you're sort of in more of a pickle there. There's programs for both willful and non-willful failure to file, and then the penalties there will depend upon the circumstances. Let's take a look at the streamlined compliance procedures. This is one of the programs where you didn't pay your tax, you didn't file your FBAR, but it's a non-willful failure to file. You have to have reasonable cause. You can't say, my dog ate all my papers, I didn't get to file my FBAR. You know, they want a good reason why you didn't do this. So if they do allow you to go through this program, you'll have to file amended returns for the last 3 years for any foreign income that you didn't report on your 1040, pay the tax, any penalties. And then they want the past 6 years FBARs if it goes back that far. They will hit you with a 5% penalty on the underlying assets per year. So it should be less, hopefully, than the $10,000 or the bigger penalty. And then you won't, if you do comply with this, you won't face any acts-related penalties, which can be pretty high. However, none of these programs apply. If the IRS catches you first, they're not going to let you enter any of these voluntary disclosure programs. So if you're under audit and they discover you had foreign income, you had foreign accounts you didn't report, you know, they could do whatever they want to you. Now, let's say it's a willful failure. Let's say you knew about the tax, you knew about the FBARs, you decided you weren't going to do it. There is a program available called the Offshore Voluntary Disclosure Program, OVDP. You have to apply for this in order to get into this program, and who you apply with is the IRS Criminal Investigation Unit. I don't know about you, but that name just gives me the shivers. I don't know if I want to be in contact with them. But if they do accept you, they are going to want 8 years of amended returns if it goes back that far, and they are going to want the FBARs for the 8 years. Now, they're still going to hit you with those penalties, but sometimes you can negotiate it if you have, you know, semi-good reason for not filing these. The key here is it protects you from criminal prosecution. I didn't mention criminal penalties earlier, but they can hit you with up to $250,000 to $500,000 in penalties, or 5 to 10 years in jail. So that's the big serious one there. You want to avoid that at all costs. So if you do know anybody or that wants to come forward, this is the way to go, especially to get out of those criminal penalties. It's just, that's not the way you want to end that. And with that, I'll turn it back to Mike.
Thanks, Rick. Before I go into the income tax treaties, I just had a couple of follow-up points. We talked about some of the FBAR filing requirements last year, and we wanted to expound upon that this year with respect to some of the programs that are out there, because we've seen, not our own clients, but some new individuals that have come into the firm we've done work for over the last year or so. They've been in this jackpot of, I should have been filing this form, but I didn't file the form. What am I supposed to do? So we've, you know, done a little bit of research on these programs that Rick touched upon, and we've gone, you know, through this process a little bit to see sort of how it works. And so that avenue is out there. We wanted to make everybody aware of that. And as Rick had mentioned too, we do put this information in all the organizers that we send to all of our clients that says, well, you know, do you have a foreign bank account? And there's a yes or no checkbox there. So you can really let us know right up front, hey, I do have this bank account. And then that, you know, puts a red flag in our head. So we know we need to dig into those details a little deeper to figure out whether you're supposed to file this form. We also put it in our engagement letter. It's right there in bold print, I think, on the first page. It says, hey, if you have this type of information, you need to file this form. And if you don't file this, well, we also put in there, this is when it's due. And if you don't file this form, here's the substantial penalties that can be associated with this. I mean, this is really such a, an easy thing, I think, for taxpayers to comply with. The problem is, what I've seen is a lot of taxpayers, they don't really know that this is out there, and they're not sure whether they need to comply with it. So again, we try to get ahead of the curve and put that question right out there to them every year. Do you have anything that would resemble something like some bank account we need to report on this form? One other thing I wanted to touch base upon that Rick had talked about is right there on that Schedule B, it does ask you, do you have a financial interest in a foreign bank account? And you check yes, and says, oh, I'm supposed to file this form. And then you right under there, it asks you, well, what country do you have it in? You spell out the country right there. And then you don't go and file that form. Well, as Rick had touched upon, there's two different programs you can go into. There's this program for non-willful failures, and there's this program for willful failures. So it seems to me like, and I haven't done all the research on this, but if you're sitting there on your Schedule B checking this form that, hey, I know I have a financial interest in a bank account, and I'm supposed to file this form, and my bank account's in this country, and then you don't go and file that form, how can you sit there and say that's a non-willful failure? It seems like that would be somewhat of an argument that's going to be tough to defeat, on your end. So you really got to pay attention to what you're putting on your tax return, especially right there on that Schedule B, because they're looking for it. And if you check the box that you're supposed to file it and you don't file that form, they are going to come after you. This has been in the news. The most publicized example that I can think about is the international investigation into the FIFA soccer organization really started here in the United States based on one gentleman who, I think it was maybe the second or third most powerful person in U.S. soccer, and he had a foreign bank account over in the Cayman Islands, and I think it was worth over $1 million. And so I don't know how they came to discover that he had some type of illegal overseas operations, but one of the items he had was a foreign bank account, and he wasn't reporting this form. And so he's facing criminal penalties, and as Rick had touched upon, 5 years imprisonment, $250,000. But if you actually commit this specific crime in connection with another tax-related or financial-related crime, then the penalties go to 10 years imprisonment and $500,000. So now here's this guy. He's facing 10 years in prison, a $500,000 fine, on top of all the civil penalties that could be associated with this. And they're asking him, hey, do you want to let us know what's going on with FIFA? And so he blows the whistle, and here we are now with this entire worldwide investigation. And I'm sure everybody's sort of seen it in the news. And it really, really started with this FBAR form and this guy really not wanting to sort of face these substantial penalties. So with that, I'm going to move on to the income tax treaties. Really what I want to say about this is all the information that Rick and I just told you, it may not even be relevant, because if there's an income tax treaty between the United States and some other country that trumps all the rules that we just talked about, then you have to follow that treaty. And the way that the actual United States laws work is you look to the federal statute and the treaty, and the later one in time is the one to control. So they're sort of on the same level. You just look at the later one in time. So they could have a statute that's been in place for 40 years, and you think that that's the applicable law, but then you look at this treaty that's just been passed 30 days ago that basically trumps that. Well, that's the one you're supposed to follow. You're supposed to follow what's in the later of time there. There's two real basic elements that are sort of embedded inside each one of these treaties between the United States and some other country. And one is the double taxation idea, and that's that we really don't want to tax the same dollar of income in two different countries. So there's this idea, it's again embedded in all these treaties that says, well, okay, depending on certain requirements, which I'm going to list out here in a minute here, depending on certain requirements, that's going to determine where that income is actually taxed. So that's in every single treaty. There's going to be a limitation there on double taxation. There's also a limitation on benefits, and I think this one is a little bit more confusing to comprehend, and that's if you're a U.S. company that wants to have some operations overseas, you may set up what's commonly referred to as a shell corporation that just sort of doesn't really do anything. It's sort of just a holding company. And the reason why you set that shell company up in a specific jurisdiction is because they have a very favorable tax treaty with the United States. But all of the activity and all the trade and all the businesses run through some other corporation that's affiliated with the shell corporation in a different jurisdiction because you have access to different materials and such. Well, again, in each one of these treaties, there's a limitation on benefits. And so if the active trader business is not where the shell corporation is, then you're not going to be afforded the benefits underneath that treaty. And so that's limitation on benefits. There's two different kinds of model treaties out there. There's the OECD model, which again, I talked about before, that group of 34 industrialized nations, and they've set up their own model and sort of the starting point. Okay, if we want to enter into an income tax treaty between two different kinds of countries, here's one model we can look at, and you can go through and see all the articles that are there. And the countries go through it, they tweak it and twist it and make it the way they want it to be, but it's sort of just a base point. The U.S. has their own model that we use, so that's the base point by which we use to enter into a treaty with some other country. And A couple of the elements that you're going to see in all of these treaties is an element based on residency. So there's going to be a specific article in these income tax treaties that say, okay, here's how we determine whether you're a resident of country A or country B. And if you read it, it says something like, you know, you're doing business in one contracting state and then you're doing something in another contracting state. It can be very confusing. I sort of cross out the contracting state and other contracting state and sub in the actual countries because it's just so convoluted and confusing. There's typically always going to be an article on business profits. So you can look and see, okay, we're earning business profits. How do we determine, are they earned in the United States? Are they earned in some other foreign jurisdiction? Because that may tell you which country is going to get a piece of the pie there. Where is that income going to be taxed at? Another element is compensation for independent personal services or compensation for personal services, whether you're an employee of a certain corporation doing activity in a different country or in your home country or wherever the case may be. So there's specific definitional rules in there about, again, where's the income earned? Where is it going to be taxed at? What's your qualification? Is it an independent personal service? Are you an employee? Are you earning a wage? Are you earning a board of directors fee? What are we going to do with all that? And then the one I think we get the most questions about is the interest, the dividends, the rents, the royalties, all those types of payments that are crossing borders. So we may have an interest payment from one entity to another entity, and it's crossing from the U.S. and it crosses the border between the U.S. and Canada and goes to a Canadian entity. And the question we always get is, well, what's the withholding rate on that? What are we supposed to withhold? Are we supposed to withhold? Typically, the U.S. always defaults with a 30% withholding rate. But I can tell you that typically when you read these treaties, there's always going to be a reduced rate. So again, you start with a 30% rate, dive into the treaty, figure out, okay, maybe it's 10, maybe it's 15, maybe it's 5. And we have a lot of research materials in our office, and everybody can go on the Treasury Department's website and see all of the income tax treaties that we have with other countries. They're all listed there. Again, they can be a little bit confusing, but as Rick and I obviously will be available after the break here with any questions you may have regarding that. And as I mentioned at the beginning, Rick and I, we kind of feel like these are sort of the hot international IRS forms that we feel like you should know in light of our presentation, but then also in light of the developing world right now. And you see these forms maybe in the news, or you work in a specific entity, you see this form, so, well, what is this all about? Well, that FinCEN Form 114 that Rick touched upon, that is the FBAR filing form. It's a 2-page form. It's actually surprisingly pretty easy to fill out. The confusion is really trying to figure out whether I need to file this thing. And like I said, there are substantial penalties with this. Although we recently, I think I had assisted somebody file this form, and it was maybe 15 or 20 pages because they had that many accounts, and you have to specifically break out each one of them. The Form 5471 is really for outbound transactions that we had discussed earlier on in our presentation. So if you have if you're a corporation that has any outbound transactions, you have to report those on this form. I believe there are substantial penalties for not filing this form also.
Yeah,
if you're supposed to file
I think it's $10,000 per occurrence.
$10,000. So if you really need to pay attention to this to make sure if you're supposed to file this form, you better file it. Now, the very first page is a lot of identifying information, but the second page is actually a full-blown income statement, I believe, that's pretty much asks you, hey, what income do you have from this other corp? What expenses do you have? What type of loan balances? What types of inventory have you purchased? All the different, there's several items on that form. Form 5472 is basically the reverse of that. So you have the transactions coming in from a foreign corporation, and I think there are substantial penalties with this form also.
Yeah, it's 10 grand again, yep.
10 grand on this form too. 8938, we touched upon this last year a little bit. This is the FATCA filing form. Like we've said throughout our entire presentation that the U.S. taxes its citizens and residents on their worldwide income. So if you have certain specified foreign financial assets, and they're generating income, you're supposed to report the income on your 1040 and then pay the tax on it. But there's also this other special form that you need to file with your 1040. It's 8938 that specifically breaks out all the financial assets and the income associated with it. And I believe there's penalties for not filing this form also.
Yeah.
That can be substantial. The W8 BEN and BENE, this is really for payments you're making to individuals or entities, and you're really not sure, hey, are they a U.S. citizen? Are they a U.S. resident? Are they a foreign corp? Are they a U.S. corp? So you can get this form, you can supply this form to whoever you're making a payment to or contracting or doing business with, and ask them to fill it out, and that's sort of the piece of paper that you keep in your back pocket that says, well, here's why I didn't have to have a withholding, or here's why I'm going to withhold something. So you can get some identifying information from, again, the individuals or corporations that you're doing business with. As Rick had touched upon, that 1040 NR, that's the individual filing form for non-resident aliens. It looks a lot like just the regular individual 1040 form. But again, like I had mentioned before, there's that special line item after you calculate your tax for the tax on not effectively connected income, where it's just taxed on, there's a 30% tax on that. So again, you don't get any of the deductions, credits, or anything to reduce your taxable income, which is just a straight 30%. Again, unless the treaty trumps that and says we're going to tax it at a different rate. 1040C, this is for departing aliens. It's just a short questionnaire form. So if you're an alien departing the country, the IRS asks you to fill out this form and turn it in. It's just a short one-page form.
You want to make sure you've complied with all your U.S. liabilities.
Maybe 15, 20 questions or so on that.
Yep.
1042 series forms, those are the withholding forms for cross-border payments. So if you have an interest payment, a dividend payment, rent, royalty, anything of the like that is going across the border, you make that withholding and pay it into the IRS, and you supply these 1042 series forms to the recipient. And then there's an annual transmittal form that you would also supply to the IRS to let them know, here's what the payments were, and here's what the withholding is, and here's the withholding. The form 1116 and 1118, those are the foreign tax credit forms. We didn't really talk about the foreign tax credit, but there's detailed calculation on how that's all working. The 116 form is for individuals, and the 118 form is for entities. The 8832 form I touched upon, that's the entity classification form for foreign entities. So again, if you have a partnership or an LLC or corp and you want to change the entity classification for U.S. tax purposes, you would have to fill this form out with the IRS, and you can't change your entity classification but once every 5 years. So you got to make sure you get this right the first time. Form 8833 is the treaty-based return disclosure form. So if you are taking a position on one of your tax returns that the applicable U.S. statute doesn't apply to you because the treaty says otherwise, you've got to put this form in there and explain what provision you're looking to that says that this is the way I'm supposed to operate or pay the tax, or how do I report the income. That's the 8833. Rick had touched upon the 2555. Again, that's a foreign earned income exclusion. And we didn't expound upon this too much, but actually underneath where you calculate your income exclusion, there's also a housing deduction piece to that also. So if you are getting housing allowances over in a foreign jurisdiction for work that you're performing over there, there's the ability that you could exclude some of that income also.
Yeah. Mike, myself and Mike will be available the rest of the day. If you have any questions, please feel free to ask us. Try to keep the autographs to a minimum. But yeah, we'll be here to help you. And with that, we're going to turn it over to Jeff and Erica.